In other words, while Snap did get access to the public's money, the public have little to no access or say in the direction of the company. Which might explain why they get away with certain things like this. Stock-based compensation. From 2016 to 2017, revenue in Snap went from $404 million to $824 million. Now, although that may sound impressive, those figures are quite small when you take into account the general and administrative expenses went from $165 million to $1.5 billion. At the same time, R&D in 2016 to $1.5 billion. So in other words, we have seen a doubling in terms of revenue, but almost a 10x increase in both general and admin and R&D. Some companies do invest a lot in R&D, and this investment tends to pay off in the long run, as R&D by accounting practices is expensed all at once, whereas the results can parlay many years into the future. This is not the case at all for Snapchat. The R&D and general and admin expenses are primarily due to stock-based compensation. So in other words, the company is compensating their individuals, including their CEO, quite heavily while the company is at a deficit in terms of net income. If we look directly from their 10K annual report again, they quote us saying, the increase in R&D was due to a $1.1 billion increase in stock-based compensation. In sales and marketing, there was a $232.5 million increase in stock-based compensation expense. And in regards to general and admin, the increase was primarily due to an increase in stock-based compensation at an expense of $1.2 billion composed of and awarded to our CEO. The total of these stock-based compensations was a $2.6 billion expense. The company, subsequently, in 2017, was at a deficit of $3.4 billion. So in other words, stock-based compensation accounts for 76.62% of the company's loss. I believe this sends a message that the executive compensation is more important than the well-being for shareholders, and that they are perfectly fine with their compensation being the cause of shareholder value and deterioration. As I said, 76% of the loss is from stock-based compensation. And with these executives holding almost all the voting rights, you could say they've hit the jackpot. If there was ever a scale as to how much a CEO cared about his company, he would have Evan Spiegel on the far end and Steve Jobs on the other. From 1997 to 2011, Steve Jobs identified that Apple was struggling, and in observing this, he accepted a $1 a year salary. This method has been followed by Zuckerberg in Facebook, as well as some other executives in Oracle and Hewlett-Packard. It is often a talking point and part of the analysis where many top investors look at executive pay as a portion of net income to gauge a better understanding of management's vision. In other words, a lot of executives talk about their company in highlights, but as they say, actions speak louder than words. In the case of Evan Spiegel, not only is Snapchat not profitable, but he is more than happy to account for 76% of the deficit they have accumulated, and this may not change anytime soon. The 2017 annual report also quoted as saying, unrecognized stock-based compensation is expected to be recognized over a weighted average of 4.2 years. So with Snap's 75% stock decrease since its IPO, where does the valuation lie? Well, because Snapchat isn't profitable, we can't measure them from an earnings perspective, so we look at them in terms of price to sales. And when looking at their price to sales, they stand at about 8.8. Compared to other advertisement and social media companies, you can see they are more or less within that certain range. But a word of caution for investors. Snap's price-to-sales ratio has been decreasing quite rapidly, and that's because most people do not have rosy forecasts for the company going forward. All these financial metrics are screenshots of the company in the present day, so although sales are increasing for Snapchat, the price has depreciated, and although some may perceive this as a value play, it can also be considered a value trap. After all, their business model is under siege. When we look at Instagram Stories has actually overtaken Snapchat, whereas Snapchat has stagnated, Instagram continues to grow. One of the ways we can see Snapchat getting out of this pickle is by being acquired, and there has been some whispers about one of the few big tech giants looking to Snapchat as an acquisition target. Primarily, we've seen rumors with Google, Microsoft, and Amazon being interested. Amazon in particular has recently engaged in a partnership with Snapchat, where you can now search for products on Amazon simply by scanning or taking a picture of the product through Snapchat. This is a bonus for both platforms, and it gives access to Amazon for nearly 200 million daily active users. Evan Spiegel recently hired 2 new executives to be his so-called right-hand men. With the departure of one of his main executives in Imran Khan, they've added to the team Jeremy Gorman, who will become the Chief Business Officer. You should take note that he was previously the head of advertising sales for Amazon. He may be the piece of the puzzle that connects these two. This might be an attractive avenue. However, for now, Snap's business model in the long term does look gloomy, with price targets around $5, well below its market price, and earnings estimates expected to decrease, and market participants have reacted accordingly, with 141 million shares short, or 15% of its market cap. You could say that some investors might soon need to snap out of it. We want to thank you guys for listening, and once again, happy investing.